Silver just exploded to a record high of $85 per ounce in Shanghai. Let that sink in. While most investors are focused on interest rates, CPI prints, and short-term technical levels, the silver market is flashing a signal that historically appears only during periods of structural stress. Not speculation, not momentum trading, not retail FOMO, structural stress, the kind of stress that precedes systemic repricing events, the kind of stress that forces markets to acknowledge reality rather than maintain comfortable fictions. And right now, at this very moment, silver is trading at meaningfully different prices depending on where delivery actually matters. Shanghai, a market built around physical settlement, is pricing silver above $85 per ounce. Western benchmarks, dominated by derivatives and rolling contracts, are lagging behind at $79, being dragged higher reluctantly, kicking and screaming. This is not a regional premium. This is not logistics. This is not tax differences or currency fluctuations. This is a $6 gap between the price of real metal and the price of paper promises. And when that gap exists in a commodity as critical as silver, history teaches one lesson. The resolution is never academic. It is always forced. In this comprehensive breakdown, I'm going to prove why $85 in Shanghai is not a spike, but a signal. I'm going to explain the structural differences between physical settlement markets and paper derivative markets. I'm going to walk you through 2,000 years of monetary history to show you why the current gold-to-silver ratio represents one of the most extreme distortions in recorded civilization. I'm going to detail why industrial demand for silver is fundamentally different from speculative demand and why that difference matters right now. I'm going to show you the supply-side reality that makes this shortage inevitable, not temporary. I'm going to explain why arbitrage, the mechanism that's supposed to close price gaps, is actually exposing the gap rather than closing it. And I'm going to give you the framework for understanding what comes next. Because when physical markets take control from paper markets, the adjustment phase does not wait for consensus. It does not wait for analysts to update their models. It does not wait for retail investors to feel comfortable. It just happens. Fast, violently, permanently. This is the story of the day Comex lost control, and why the price you're seeing on Western screens is already obsolete. Let me start with a fact that cannot be ignored. Silver is trading at $85 in Shanghai right now. Not yesterday, not last week. Right now. And even the coordinated pricing centers of the LBMA and Comex are failing to stop this move as silver accelerates toward the physical benchmark that Shanghai represents. When price keeps moving despite visible effort to contain it, the message is simple. Control is weakening. For decades, Comex set the global price of silver. What traded in New York became the reference price for contracts worldwide. Miners used it. Manufacturers used it. Investors used it. It was the benchmark. But something fundamental has changed. The benchmark is breaking, and the fracture is visible in real-time price data. Let's establish the current structure. Comex silver is trading at approximately $79 per ounce. That's the paper price. That's what shows up on your broker's app. That's what financial media reports. But the Shanghai Futures Exchange is trading at $85. That's a $6 gap. That's 8% higher than the Western price. That's not a premium. That's a different market. Now, I need you to understand something critical about how these markets function. Because the difference isn't just geographical. It's structural. The Shanghai Futures Exchange and the Shanghai Gold Exchange operate with a clear bias toward physical delivery. Industrial users participate directly, refiners participate, manufacturers participate, state-linked entities participate, and they demand metal, not exposure. When they buy a contract, they expect to take delivery. They expect physical bars to arrive at their facility. They expect to melt that silver and turn it into solar panels or batteries or electronics. Physical settlement is the norm, not the exception. The Comex, by contrast, has a leverage structure where open interest routinely represents multiples of annual global mine supply. This is not controversial. This is documented. According to CME data, only a tiny fraction of Comex silver contracts ever result in delivery. Some estimates put it below 3%. The rest are rolled forward, or closed out, or cash settled. The system is designed around financial settlement, not physical delivery. And this system works as long as physical demand stays quiet, as long as industrial buyers don't suddenly demand delivery, as long as investors don't question whether the metal actually exists. But it fails when physical demand becomes urgent, when factories need silver today, not next quarter, when manufacturers can't wait for Comex to find the metal. That's when the system breaks, and we're watching it break right now. Here's how you know. Shanghai at $85 is not being driven by speculators. It's being driven by industrial buyers who need physical delivery. They're paying $6 over the Western price because they can't get metal at the Western price. They've tried. They've called suppliers. They've checked availability. And they've learned the brutal truth. Comex silver at $79 is a theoretical price. It's the price you can see on a screen. But it's not the price you can actually transact at if you need physical metal delivered to Shanghai. So they pay $85, because that's the real price. The price where actual metal changes hands. The price where delivery happens. And here's what makes this critical. Once a physical settlement market establishes a higher price, that price becomes the new reference for anyone who needs actual metal. Comex can pretend all it wants that silver is $79, but if you're a factory in China and you need silver, you're paying $85. And if you're a factory in Germany and you need silver, you're looking at Shanghai pricing, not Comex pricing. Because Shanghai is where the metal actually exists. Comex is where the promises exist. This creates a feedback loop. The higher Shanghai goes, the more obvious it becomes that Comex doesn't have metal. The more obvious it becomes that Comex doesn't have metal, the more buyers shift to physical markets. The more buyers shift to physical markets, the higher Shanghai goes. And Comex is dragged along, reluctantly, kicking and screaming, trying to maintain the fiction that they're still in control. But they're not. They've lost control. And the gap is the evidence. In part 2, we're going to put this in historical context. Because what's happening right now has happened before. Not in silver specifically, but in commodity markets generally. When paper pricing systems decouple from physical reality, they eventually reset. And the reset is never gentle. Stay with me. We're going into 2,000 years of monetary history to show you why this moment matters. If you're just joining us, we've established that silver is trading at $85 in Shanghai, while Comex shows $79. That's a $6 gap between physical and paper, and we've explained the structural differences between these markets. In part 1, we showed the gap and the broken control. In part 2, we need to understand why this matters from a historical perspective, because silver has thousands of years of monetary history, and that history teaches clear lessons about what happens when price distortions become extreme. Let me take you back to the Roman Empire. In the Roman Empire, the gold to silver ratio averaged between 10 to 1 and 12 to 1 for centuries. That means 1 ounce of gold was worth 10 to 12 ounces of silver. Why? Because that roughly reflected the relative scarcity and availability of these metals above ground. Romans mined both. They understood both. And the market naturally settled at this ratio based on supply and demand. During the bimetallic standards of Europe and the United States in the 18th and 19th centuries, legal ratios clustered near 15 to 1. Governments established this ratio by law. You could exchange 15 ounces of silver for 1 ounce of gold at government mints, and this ratio held for decades because it roughly matched the natural scarcity of the metals. These ratios were not arbitrary. They were not manipulated. They reflected relative scarcity and availability above ground. But today, the ratio fluctuates around 90 to 1. Gold is approximately $4,200 per ounce. Silver is approximately $79 per ounce in the West. That's a ratio of 53 to 1. Even using Shanghai prices of $85, the ratio is still 49 to 1. That places silver at one of the most extreme relative valuations in recorded monetary history. Think about what that means. For 2,000 years, the ratio averaged between 10 to 1 and 15 to 1. Today, it's 49 to 1 to 53 to 1. That's a 3 to 5 times distortion from historical norms. And every prior instance of such extremes eventually resolved through violent repricing. Either silver surged, or gold collapsed, or both moved to reestablish the historical relationship. There is no historical example where such distortions corrected gently. Let me give you specific examples. In 1980, the gold to silver ratio compressed to 17 to 1 during the Hunt Brothers rally. Silver exploded from $6 to $50. The ratio normalized violently. In 2011, the ratio compressed to 31 to 1 during the post-financial crisis rally. Silver surged from $18 to $49. Again, violent compression. Both times, the correction happened in months, not years. Both times, silver outperformed gold by multiples. Both times, the ratio reverted toward historical norms through price action. And here's what matters for today. The current ratio of 49 to 1 to 53 to 1 is more extreme than it was before either of those rallies. Have you ever wondered why the gold to silver price ratio is so important? In 1980, right before a major price explosion, the gold to silver ratio was around 30 to 1. In 2011, just before another huge rally, it was about 60 to 1. Today, using the Shanghai price, it's sitting at 49 to 1. We are right in that historical zone where a major correction, a mean reversion, becomes highly likely. Now, let me explain why this price distortion even exists and why it's completely unsustainable. One of the most misunderstood facts in the world of commodities is the difference between the above-ground stocks of gold and silver. According to the World Gold Council, we have over 200,000 metric tons of gold above ground. That's about 6.4 billion ounces. And that gold is largely intact and recoverable. It's sitting in central bank vaults, private vaults, and in jewelry that can easily be melted down. It's all there, available and ready to be sold back into the market. Silver is a completely different story. The Silver Institute and various academic studies estimate that a huge portion of all the silver mined over the last century has been consumed, scattered, or made uneconomic to recycle. Think about it. Silver goes into electronics in tiny, almost unrecoverable amounts. It goes into solar panels where it's locked away for 25 years. It's used in medical applications and then disposed of. It's lost in countless industrial processes. Unlike gold, which is hoarded, silver is consumed. This single fact changes everything. When gold prices rally, old gold comes flooding back to the market. People sell their jewelry. Central banks might sell some reserves. This massive above-ground supply acts as a buffer, soaking up demand and keeping prices in check. But when silver rallies, there's no comparable buffer. The silver that went into your old iPhone is gone forever. The silver in a solar panel installed 5 years ago won't see the light of day for another 2 decades. The silver used in industrial chemistry is dispersed beyond any economic hope of recovery. So the truly available, above-ground supply of silver is just a fraction of what exists for gold. Some estimates put the total at maybe 2 to 3 billion ounces, with even less in a readily available form. This means the gold to silver ratio, based purely on available metal, should be closer to 2 to 1 or 3 to 1, not 50 to 1. The distortion is massive, and it's unsustainable, because above-ground supply is what determines how much metal is actually available when demand surges. And right now, available silver supply is incredibly tight, while demand is absolutely exploding. We've established the historical context, we've seen the price gap in Shanghai, and now we need to understand the demand side. Because this is where the story shifts from just being interesting to being inevitable. Silver isn't rising because of a temporary wave of investor enthusiasm. It is rising because our modern infrastructure literally cannot be built without it. Let's start with solar panels. According to the International Energy Agency and the Silver Institute, the solar industry alone consumes hundreds of millions of ounces of silver every single year. In 2024, that figure was approximately 200 million ounces. That's a quarter of the entire annual silver supply. And solar deployment isn't slowing down, it's accelerating. China is installing hundreds of gigawatts. Europe is pushing renewable mandates. The US has massive subsidy programs. India is ramping up. Every major economy on Earth has committed to net zero carbon, and solar is the main tool they're using to get there. But here's what most people don't get. You cannot build a modern solar panel without silver. There is no substitute that maintains efficiency. Silver paste is what conducts the electricity from the silicon wafers. It's the pathway that turns sunlight into electrons. Without silver, the panel simply doesn't work, and the newer, more efficient panels are using more silver, not less. The next generation of solar cells, technologies like TOPCon and HJT, require 50 to 80% more silver per panel than the older tech. Why? Because higher efficiency demands it. To get from 20% to 24% efficiency, you need more conductive pathways. You need more silver. So, as the solar industry upgrades, silver consumption is increasing. This is the exact opposite of what analysts predicted. They all said thrifting would reduce silver use. They were completely wrong. And solar is just one piece of the puzzle. Electric vehicles are the next massive demand driver. A regular gas-powered car uses about 15 to 20 grams of silver in its switches and electronics. An electric vehicle uses double that amount, between 30 and 50 grams. But get this, the next generation of EVs, especially those with solid-state batteries, could use between 500 grams and a full kilogram of silver per vehicle. That's because silver solves critical problems in battery technology. It prevents dendrite formation, allows for faster charging, increases energy density, and improves safety. And manufacturers like BYD and CATL are racing to deploy this tech not in 10 years, but in the next 2 to 3 years. Let's do the math. If solid-state batteries require 500 grams of silver per vehicle, and global EV production hits 30 million units a year, that's 482 million ounces of silver. That's more than half of the current global mine supply, just for EVs. Add the 200 million ounces for solar, and we're at 682 million ounces. Then add 5G infrastructure, with silver in millions of cell towers. Add AI data centers, which require massive silver-based electrical connections. Add medical devices, where silver's antimicrobial properties are essential. Add all our smartphones and laptops. In so many of these high-tech applications, substitution is either impossible or results in total performance failure. Industrial demand doesn't speculate, it secures supply. When the price of silver rises, a solar manufacturer has a choice. Pay the higher price or shut down production and lose a multi-million-dollar contract. What do you think they're going to do? They'll pay the higher price. They have to. This is why industrial demand is price inelastic, and it's why Shanghai's price is so high. It's not about speculation, it's about survival. And this demand isn't going away. It's a permanent step change in the industrial consumption of silver. but the supply side simply cannot respond. This brings us to the final critical piece of the puzzle, supply. This is where the situation becomes a simple matter of math. The global supply of silver cannot respond to price increases the way other commodities can, making this shortage structural, not temporary. Let me start with a fact that shocks most investors. Roughly 70% of all the silver mined in the world comes as a byproduct of mining other metals, primarily copper, lead, and zinc. This means silver supply isn't driven by silver prices, it's driven by the prices of those other metals. Think about it. If a company is deciding whether to open a new copper mine, they're looking at the price of copper. The silver they'll get is just a bonus. So even if silver's price doubles, it doesn't automatically trigger the development of new mines because the primary economic driver is still copper or zinc. This disconnect means a huge chunk of silver supply is totally unresponsive to silver's own price signals. What about the other 30%? Those are primary silver mines, mines that target silver specifically. But they face immense challenges. Getting a permit to build a mine can take 5 to 10 years. Securing financing is incredibly difficult. And even after all that, it takes another 3 to 5 years to actually build the mine and start production. From the moment of discovery to the first ounce of silver being produced, the timeline is often 10 to 15 years. This creates a structurally inelastic supply curve. There is no quick fix. You can't just flip a switch and get more silver. So what happens when you have a situation where demand is exploding and price inelastic, and at the same time, supply is structurally rigid and also price inelastic? Price becomes the only variable that can adjust. There is simply no other release valve for the pressure building in this market. The fundamental non-negotiable demand from industries building our future is colliding with a supply chain that cannot keep up. This isn't a forecast or a prediction. It's an economic certainty playing out right before our eyes. Here's a thought you can't escape. When supply can't budge and demand won't quit, price is the only thing left to give. And right now, it's giving. We've watched silver climb from $20 to $30 to $50, and now we're seeing it hit $79 and even $85 in Shanghai. But here's the kicker. Even at $85, there's no cavalry coming. No new wave of supply is showing up in 2025 or 2026. The mines that could produce that silver are still stuck in paperwork, trying to get permits, or they're hunting for financing, or they're just breaking ground. The real supply response is a good 5 to 10 years away. Meanwhile, demand isn't waiting. It's happening right now. Solar panel installations are covering rooftops and fields as we speak. EV production lines are humming, rolling out new cars every minute. 5G towers are going up, connecting our world. The timing is completely off. Demand is accelerating into 2025 and 2026, while new supply might, if we're lucky, show up between 2030 and 2035. That 5 to 10 year gap, that's the crisis. Now, I know what the skeptics are thinking. They'll say, as the price goes up, so recycling will increase. That'll solve the shortage. And you know what? They're partially right. Recycling does increase with price. But here's the part they miss. Silver recycling is fundamentally limited. Think about gold. Gold recycling is easy. It mostly sits in jewelry boxes and bank vaults. And when the price is right, people sell, it gets melted down, and it's back in the market. The recycling rate for gold is over 90%. Silver is a totally different story. It's not concentrated, it's dispersed. It's used in tiny amounts inside your electronics. It's locked away in solar panels for decades. It's in medical supplies that get thrown away. The cost to pull out 0.2 grams of silver from an old smartphone is way more than what that silver is worth, even at $85 an ounce. So it doesn't get recovered, it ends up in a landfill. The recycling rate for silver is less than 20%, and even if we could magically double or triple that rate, it still wouldn't be enough to close the supply gap. Right now, recycling gives us about 180 million ounces a year. Let's say it doubles to 360 million. Industrial demand alone is already at 680 million ounces and climbing. Add that to the 830 million ounces from mines, and you get a total supply of about 1.19 billion ounces. The problem is, total demand is already approaching 1.3 billion ounces. We're still in a deficit. Recycling helps, but it doesn't fix the core structural problem. So let's recap. We have demand that's growing and won't back down. We have supply that's constrained and can't speed up. And we have recycling that's limited by basic physics and economics. That leaves one single lever to balance the market: price. And the price is adjusting. That $85 figure in Shanghai is the market adjusting to reality. The $79 price on the Comex, that's denial. But denial can't change physical reality. The metal just isn't there. In this final part, we're going to expose why the textbook solution, arbitrage, is failing, because arbitrage is supposed to be the great equalizer. It's what should prevent Shanghai from trading $6 higher than New York. So why isn't it working? The answer is simple. Arbitrage requires physical metal, and the metal isn't available. Stay with me, because this is the mechanism of collapse. We've shown you the $85 price in Shanghai. We've laid out the historical context, the demand explosion, the supply constraints. Now, let's tackle the final piece of the puzzle, arbitrage. In theory, it's simple. A trader sees silver at $79 in New York and $85 in Shanghai. They buy in New York, ship the metal to Shanghai, and sell it for a tidy profit. This buying in New York pushes the price up, while the selling in Shanghai pushes it down. The prices meet in the middle and the gap closes. That's how it's supposed to work. But reality is a different beast. To pull this off, traders need to get their hands on actual physical silver. And right now, the reports from the LBMA vaults and exchange inventories tell a scary story. The amount of deliverable silver is just a tiny fraction of all the paper claims on it. The Comex registered silver, the metal that's ready for immediate delivery, is below 70 million ounces. But the open interest, the total number of paper contracts, represents over 900 million ounces. That's a leverage ratio of 13 to 1. For every single physical ounce in the vault, there are 13 paper claims. This system works just fine as long as nobody asks for their metal all at once, as long as contracts are just rolled over or settled in cash, as long as people have faith in the paper. But when a physical shortage hits, when Shanghai is willing to pay $85, traders want to do that arbitrage trade. They want to buy on Comex and ship it east. But to do that, they have to demand delivery. And when they do, they discover the vaults don't have enough metal to satisfy that kind of demand. So what happens? The arbitrage trade begins. Traders buy Comex futures. The price inches up from $79 to $80. They request delivery. The Comex scrambles. Registered inventory drops. Availability gets even tighter. By the time the metal is delivered and shipped, Shanghai's price has already moved to 87. The gap didn't close, it just shifted higher. And the whole process drained the Western vaults even more. This is why, in a physical squeeze, arbitrage doesn't close the price gap. It exposes it. It proves the gap exists because the metal is scarce. It proves the Comex doesn't have the inventory to back up its paper promises. And once that becomes clear, confidence in the paper market begins to crumble. This is how major commodity repricing events always begin. Not with a bang, but with a whisper. A small price difference appears. Arbitrage should fix it, but it can't. The premium stays. It grows. More traders try to jump in, which puts more demand on physical delivery. Inventories drain faster. The premium widens even more. Eventually, the paper market loses its authority. The physical market takes control. And the price reset happens violently. We saw this with palladium. We saw it with rhodium. And we're seeing the early stages of it right now with silver. The story isn't that silver hit $79 or $85. The real story is that every attempt to suppress the price, to cap it, has failed. Silver just keeps grinding higher, step by step, pulled by the gravity of the physical market. This isn't a speculative spike. It's a relentless grind. And grinds driven by real physical demand are the hardest to stop. You can't use algorithms to suppress a market when the shortage is real. You can't smash the price with paper selling when factories need physical metal to build their products. The Comex is losing control, not because it wants to, but because it has to. The metal is in Shanghai. The demand is in Shanghai. The price is being set in Shanghai. So what comes next? This isn't a prediction, it's a signal. When pricing systems get disconnected from reality, they eventually reset. And it's not gradual or polite, it's violent. We've seen this movie before. Nickel in 2022. The London Metal Exchange had to halt trading after prices shot up 250% in 2 days. Why? A major player couldn't deliver the physical metal. The paper market broke. Tin in 2021. Prices doubled in months because supply couldn't keep up. The pattern is always the same. A physical shortage appears. Paper markets deny it. A premium develops between physical and paper prices. The premium widens. Arbitrage fails. Confidence erodes. Then comes the violent repricing event, where paper is forced to catch up to physical reality. We are in the middle stages of this pattern right now. Physical shortage? Check. Paper markets in denial, with Comex at 79 and Shanghai at 85? Check. A $6 premium? Check. Arbitrage failing? Check. The only stage left is the violent repricing. It's not a matter of if, but when. And when it comes, the Comex price will gap up. Maybe $4 in a session, maybe $6. It will be fast and without warning. So understand this. $85 in Shanghai isn't extreme, it's reality. $79 on the Comex isn't the price, it's denial. And denial always ends. The only questions are when and how violently. Historically, the repricing accelerates once that price gap exceeds $8 to $10. We're getting close. The gap is $6. If Shanghai pushes to 87 while Comex lags, we enter the critical zone. Once the gap hits double digits, psychology changes. Industrial buyers panic, investors question the paper markets. The media starts covering the story, and a feedback loop kicks in. Shanghai hits 89. Comex is forced to 81, but the gap is still $8. The chase continues until the Comex is forced to admit they can't hold the line. They gap up to 83, but by then, Shanghai is at 92. During this chase, anyone shorting the market gets destroyed. This is how markets resolve extreme distortions. Not calmly, but through panic and forced liquidations. The bottom line is this. The silver market is no longer being led by paper. Physical reality is taking over. Shanghai at 85 is that reality. Comex at 79 is the old system desperately trying to hang on. But control is slipping. The gap is widening, the vaults are draining, and the only thing left to adjust is the price. And price is adjusting. If you're holding physical silver, you're positioned for what's coming. The silver market is sending a signal, and it's getting louder every single day. If you're holding physical metal, this is the moment you've been waiting for. Your position is real, it's tangible, and it's secure. The great repricing we've all been anticipating is not just coming. It's already here, and it benefits you directly. But let's talk about the other side of this trade. If you're short silver, if you're putting your trust entirely in Comex pricing, or if you're sitting on the sidelines waiting for a pullback that might never arrive, you need to understand the immense risk you're taking. History is very clear on this. When a significant gap emerges between the physical price and the paper price of a critical commodity, that gap doesn't close politely. It resolves violently. It's not a gradual, gentle adjustment. It's a forced repricing that shocks everyone who wasn't paying attention. And right now, we are witnessing exactly that scenario unfold. We have Shanghai trading at $85, while Comex is lagging behind at $79. That's a $6 gap, and it's widening. This isn't just a minor discrepancy, it's a fundamental break in the market structure. So what happens next? When the physical market finally asserts its dominance and takes control, the adjustment phase will not wait for consensus. It won't wait for Comex to feel comfortable. It certainly won't wait for the shorts to find a graceful way to exit their positions. It just happens, swiftly and decisively. It's like a dam breaking. The pressure builds and builds until the structure can no longer hold, and then the flood comes all at once. We're seeing the cracks in the dam right now. The pressure from physical demand, led by markets like Shanghai, is becoming overwhelming. This is why paying attention right now is so critical. The signals are unambiguous. Shanghai at 85, Comex at 79. That $6 gap is a warning siren. It tells us that the paper market is losing its grip on reality. The price discovery mechanism that has dominated for decades is failing. For those holding physical silver, this is validation. It confirms that you made the right decision to own the real asset, not just a promise or a derivative. You are on the right side of history. Your metal is real. Your position is secure. But for those who are short, who are betting against silver, the situation is becoming precarious. The risk is that you get caught in a massive repricing event that happens overnight. Imagine waking up to find that Comex has been forced to gap up, not by a few cents, but by several dollars in a single session, just to catch up with the physical reality. That's not a theoretical risk, it's an increasingly probable outcome. The longer this gap persists and widens, the more violent the eventual snapback will be. Don't be the one caught off guard. Don't be the one who thought the paper market could defy the laws of supply and demand forever. Physical markets always win in the end, always. The repricing isn't a matter of if, but when. And when it happens, it will be fast, and it will be brutal for those on the wrong side. The time to understand this dynamic is now, not after the fact. The market is giving you a clear signal. The question is, are you listening? This is where we come in. We are going to be documenting this entire process in real time. This isn't about speculation anymore. This is about observation and confirmation. We will be tracking the Shanghai sessions, every single one. We will be monitoring that critical gap between the Shanghai price and the Comex price. We will be watching for the triggers, the specific events that could finally force the paper market's hand. And we will be here to report the moment Comex finally gaps up to try and catch up with reality. When that gap up happens, when Comex finally has to admit that $79 was a work of fiction and jumps to 83 or 85 or even higher in a single trading session, we'll understand exactly what it means. It won't be speculation. It will be confirmation. It will be the undeniable confirmation that the physical market has won, that the paper market has lost its control, that the repricing we all knew was inevitable has finally, officially arrived for the entire world to see. Think about what that moment will signify. It's the end of an era. The end of an era where paper contracts could suppress the true value of a physical, finite resource. It will be a paradigm shift. The power will shift from the futures exchanges back to the holders of the actual metal. For years, people have talked about this. They've written articles, made predictions, and argued about whether it could truly happen. Well, we are on the cusp of seeing it play out live. The data points are all lining up. The arbitrage is too wide to ignore. Global physical demand is relentless, and inventories on the exchanges are being drained. These are not opinions. These are facts. And facts, unlike paper prices, have a way of asserting themselves. So as we watch Shanghai push higher, remember that it represents the real world of supply and demand. And as we watch Comex lag behind, remember that it represents a world of leverage and financial engineering that is becoming increasingly disconnected from that physical reality. The resolution of this disconnect is the biggest story in the precious metal space right now, perhaps in all of finance. It has implications that go far beyond just the price of silver. It speaks to the integrity of our financial markets and the true nature of money and value. This is why you need to subscribe to this channel. We are going to be your eyes and ears on the ground. We will track the numbers, connect the dots, provide you with the real-time analysis you need to navigate what's coming. The next phase will be documented right here. We'll be watching the Shanghai sessions, we'll be monitoring the gap, we'll be looking for the triggers. We will report when Comex finally makes its move. This isn't just another market update, this is a front row seat to financial history being made. When that Comex gap up happens, and it jumps to $83 or $85, you won't be wondering what it means. You'll know it will be the confirmation that physical won, paper lost, and the repricing was always inevitable. Make sure you're subscribed so you don't miss a single moment. Thanks for watching.